Welcome back. Let's go to top picks now from John DeGoey. These are his top picks on this day. One is one that we've talked about a couple of times already, John, the BETAPRO S&P 500 Daily Inverse ETF. It provides investors with gains if the underlying index, the S&P 500, moves down.
This is a product that I think is really important that people at least be aware of the fact that it's in their toolkit. And again, I can't use it. Portfolio managers can't use it unless we are in and out the same day. So it's not a long-term strategic hold, and that becomes prohibitive for us to use. But it's the sort of thing that individual investors can use. For what it's worth, I actually use a custom-built inverse note that I've had built for me in my practice that I can use to get around the problems of HIX. But this is a great way of expressing a sentiment of being bearish without taking too much risk and actually making money in a down market. And it's the sort of thing that if you use it judiciously as a portion of your portfolio can actually make you money when other things are dropping, as we saw earlier today. So it's the sort of thing that I think has made sense so far in 2022, and I think will continue to make sense for the remainder of the year and quite possibly even beyond that.
Okay, and here's one that sounds very similar, the BETAPRO S&P TSX-60 Daily Inverse ETF. This sounds like one that would move up when the TSX Large Cap Index, the TSX-60, moves down.
Exactly right. So it's a sister product to the one we talked about a moment ago. It's inverse on the TSX-60. And if one is of the opinion that there are hard times ahead, and again, I'm not trying to be a nervous Nelly, I'm just trying to be realistic here. There is an opportunity here for people for those who share my sentiment that it's going to be more difficult going forward than it has been for some time because of having to fight central bankers, because central bankers will continue to raise rates, because they have to fight inflation, even though the economy is soft, and that will wear on the performance of capital markets. This is a way to actually make money when capital markets are being hammered, as they, I think, almost inevitably will have to be as these rate hikes continue to play their role.
Okay, and finally, good old cash. You think cash is an asset worth holding right now? Pretty
exciting, huh? Again, I'm not suggesting everyone sell everything and put their money in cash, but whatever position you have, if you can't decide what to buy, if you're concerned, if you're defensive, if you think interest rates are going to go up and as a result you don't want to buy more bonds, but you've got bonds that are coming due, maybe you should wait and just keep that money in cash, keep that money in T-bills, get something. But the idea here is to not lose money, because I think the premium for the remainder of this calendar year will be on playing defense and not losing money rather than trying to maximize your return, which is different from what you see, 4 times out of 5 or 9 times out of 10.
There are different ways to own cash. You can hold pure raw cash in your brokerage account. You can invest in a money market fund. We've shown the phrase treasury bonds on our screen as we've had this discussion with you. You can also go to a bank or even non-bank GICs. There's some pretty attractive rates out there on guaranteed investment certificates right now, better than 4% on a 5-year GIC and a little less than that on shorter term GICs. Any finishing thoughts on which vehicle investors might want to look at?
If your time horizon is long and you need income exposure, then those 5-year GICs look awfully good. Most people, however, don't like being locked in for 5 years. So if you can get something which is maybe 1 or 2 years, if you can find something which is maybe paying you a bit less, but is cashable and therefore offers liquidity, that would be a good thing as well. But any of the above, again, the idea here is not to maximize the last 5 or 10 basis points of return. It's to minimize the loss that you might experience if you were in things that drop when the market drops.